recording. All right, cool. Here it is. So we're gonna go to policy writers, provisions, options, and exclusions, and we'll do this is the one you're having a hard time with. So we're gonna do this over and over and over. Okay, so we'll do. Let's see if we could do three quizzes of the same one. Okay,
Okay.
so life income, joint and survivor settlement option guarantees income until the last one dies, pays until to emergency until they die. So so it's gonna be C. All right. So why? Why? Because whenever you see the word survivor, all right,
Okay.
whenever you see the word survivor, it pays until the last one dies. So look at C, income for two or more people, that's the joint, two or more. Until the last one, until they both die, that means until the last one died, that's the survivor part. And that's why it's the answer. You see that?
Yeah, I got you.
Cool. All right, cool. So life income means that it's an annuity. It's going to pay income, okay, for life, but it stops until the last one dies. All right. So,
Okay.
so do me a favor, go ahead and screenshot this, especially I'm going to post this up on YouTube. As you're watching this on YouTube, also screenshot this because you want to have them on your phone so that whenever you're like waiting in line at a restaurant or whatever, somewhere that where like you're at the Department of Motor Vehicles, you could check out some of these videos, some of these screenshots so that you could give yourself time to read the rationale. That's also really important because that's how things start sticking in your mind is you understand the concept because you're reading the rationale. Okay.
Okay.
Yep. All right, cool. And by the way, everything, all these type of recordings. I mean, did this help already just by me explaining this to you, right, Rihanna? Right, Reina?
Yeah, it did.
So then imagine watching these videos over and over, and that's where you could also link up on the YouTube link that we have. I mean, on the Telegram that we have. And you know what? Let me just go ahead and just talk about it real quick. So here's the Telegram right here. If I click on pin messages on the Telegram life exam prep class that I have,
Mm-hmm.
it's gonna take you to so for example, it's gonna take you to the important meetings, important things here, key facts. Let's see, huge announcement. There's a TikTok. Have you seen the TikTok one?
Yeah.
All right, and there's also a YouTube playlist, which I don't see it.
I've been watching them.
You've been watching them? Yeah.
Yeah, you're good.
It's not on the Telegram, but anyways, you see what I'm talking about. I'll send you the playlist. I have a huge playlist of like 100 of these video recordings where I'm helping people. So that's also going to be good. Just remind me to give it to you. Okay. So here, let's go to the next one. Which of the following statements about the retirement provision is true? Which of the following statements about the it's reinstatement provision is true? It permits a reinstatement within 10 years after policy has lapsed. So reinstatement is when a policy lapses, you want to reinstate it to get it back active so that the family's covered, right? So
Yeah.
it provides reinstatement of a policy regardless of the insured's health. No, you have to be healthy. You have to requalify. I don't know about the 10-year thing. That's way too long. It guarantees a reinstatement of a policy that has been surrendered for cash. No, once a policy is surrendered for cash, you can't reinstate it. It's done. It's gone. That's it. Game over.
Okay.
So just by process of elimination, I'm not even going to read D. I know the answer is D because of process of elimination. You see that?
Gotcha.
E, it requires a policy owner to pay all overdue premiums. Yep, you have to pay back your premiums that you owe with interest before the policy is reinstated. And there it is. So go ahead and screenshot that. All right, let's go to the next one. Which of the following is true about a 10-day free look period? So it begins on the policy is delivered. Yes, that's true. So the free look period, day one, starts when the policy is delivered. Okay, so don't forget that. That's very common on the test.
Yeah, I remember that one.
Remember that one? So
Yeah.
it begins when the policy is signed. Nope. It applies only to term insurance. Nope. It applies to all insurance policies. It is optional on all life insurance policy. No, it's mandatory. it's the opposite of optional. It's mandatory. There it is. The answer's there. Cool. Next one. The validity of coverage under a life insurance policy may not be contested except for non-payment of premiums after the policy has been enforced for how many years? Well, I've noticed that every state is different. Not every state is different. Some states are different. California is 2 years. What is Georgia? What do you remember?
Mm, uh, hold on one second. Let me reread it. Mm, I would. I'm not sure. These are the ones I have trouble with.
Let's go with B, 2 years. Since California is 2 years, I'm going to assume that Georgia's 2 years, and it is. There it is. So there's a 2 year incontestability period. What does that mean? Incontestability. Incontestability is when the policy's been in force for 2 years and then the person dies, they won't do investigation. They won't contest the policy. They won't be like, well, wait a minute, wait, before we pay, how did you die?
Yeah.
They ain't gonna ask you that because it's already been enforced for 2 years. But if the policy's been enforced within 2 years, then they will check to see how the person passed away, and and then try to see if there's fraud or something. You know what I mean? Like, for example, if somebody dies within 2 years by suicide, is the policy going to pay? No, because it's a contestability period. But if the person dies by suicide after 2 years, is it going to pay?
Yeah.
Yes, because it's after the contestability period of 2 years. All right. So that's what this question is all about. Okay.
Okay.
Next one. If you have any questions, just ask. Okay. Next.
Okay.
Which of following protects the insured from an unintentional policy lapse due to non-payment of premiums?
Mm, let's see. Is it A?
Yep, automatic premium loan provision. This one, what they do is
Oh,
before your policy lapses, they get money from your cash value to pay for the premium so that your policy stays in force.
got you.
Yeah. But here's another one, another thing that you can learn about this question. The automatic premium loan provision starts when? When does it start? And the answer is it starts after the what do you call it? It starts after the grace period. So remember the grace period? The grace period is when you don't make a payment, or you forgot to make a payment, your policy still is in force for 60-day grace period. Once the
Got
60-day passes, the policy lapses. Unless it has an automatic premium loan provision. After the grace period, they go, wait, don't lapse this policy because this client has cash value. We're going to get some cash value and pay the premium so that the policy stays in force. All right.
Got it.
Next one. What is the benefit of choosing extended term as a non-forfeiture option?
Um,
It matures at age 100. It allows coverage to be continued beyond maturity. It can be converted to a fixed annuity as the highest amount. The benefit is actually
D.
DY, because extended term non-forfeiture option allows you to keep the premium high. Okay. Extended
Okay.
non-forfeiture option allows you to keep the sorry, not the premium. It allows you to keep the coverage high. What is a non-forfeiture option, by the way? Do you know that, Reina?
Not off the top of my head, I don't. uh,
Okay, let's talk about it. The not extended term non-forfeiture option is an option that when the client says, hey, you know what, I can't make the payment no more, I don't want to forfeit, non-forfeit, there it is, non-forfeit, right? I don't want to forfeit. Forfeit means what? I lose the game, right? I lose the policy.
yeah.
I lose it. So I don't want to lose it. That's what non-forfeit means. I don't want to lose it. So I want to keep the coverage, but I don't want to make payments no more. So I have cash value. I want to use the cash value to pay the premiums, and then it keeps the same coverage, but now it's gonna end. The policy is gonna end when the cash value ends, right? When there's no more cash value, that's it. You can't keep the policy in force.
Got you.
Got it. So it's gonna keep the same coverage on extended term non-forfeiture option. But eventually the term is going to end. It's going to be a term insurance that eventually is going to end because you're no longer making.
Got you.
Any questions?
Okay.
This one's a little tricky.
Nah, we can keep going.
Give me 1 second. Okay, next one. What is the benefit? Oh, never mind. Make sure you're screenshotting. Which of the following information will be stated in the consideration clause of a life insurance policy?
Hold on. Is it A?
Conditions for insurability stated. Conditions for insurability. Amount of premium, parties of the contract, time period, law.
Wait, no.
Conditions
No,
of
I
insurability.
was thinking.
It's gonna be B, because here it is. Ready? Consider anything that has the word consideration. Think of money. Anything that has the word consideration, think of money. So right
Okay.
here, it's asking the amount of money payment, right? Premium payment is your monthly payment.
Okay, yeah. I was thinking for some reason I was thinking of like the conditional receipt or something.
Yeah.
Gotta make so. Okay. Let me screenshot that. Okay.
All right, next one. Which of the following allows the insurer to relieve a minor insured from a premium payments if the minor's payments have died or become disabled?
Oh, that's either A or B. Huh.
Died or become disabled. This is called the payer benefit rider. It's going to be D. So the payer
Oh,
benefit rider is when me, I buy a policy on my daughter,
mm-hmm.
and I want to make sure that if I become disabled, my daughter's policy stays active. That's called the payer benefit rider. Alrighty. So
Got
that
you.
so that right there is what is what the benefit is if I become disabled for 6 months, then this benefit kicks in, payer benefit kicks in, and the policy stays active, and we don't have to cancel nothing. Got it?
Got you.
All
Yeah,
right.
got it.
All right, cool. After a back injury, an insured is disabled for a year. His insurance policy carries a disability income benefit rider. Which of following benefits will he receive?
Um,
So we just went over this one, right? It has to do with the premiums are waived for on a monthly, the monthly premiums are waived. So that means their policy stays active, but the payments are deleted. The payments are waived. The payments are waived because of the disability income benefit rider.
okay.
Yeah, so this one they call it disability income benefit rider. It sometimes is also known as a waiver of premium. All right, waiver of premium. So it's pretty interesting how how they're calling it something else too. Maybe it's a Georgia thing, but it's in California. They put it as waiver of premium. So all right,
God.
which non-forfeiture option provides coverage for the longest period of time?
Is
Remember,
it
remember
ex-
non-forfeiture option. Go ahead.
is it C?
B, it's B. Reduced paid up. Reduced
Oh,
paid up is going to give them the biggest amount of coverage. All right. Reduced paid up is going to give them the
okay.
biggest amount of coverage. So yeah, but the so it's gonna be paid up till age 100, but the coverage is gonna go down. So if the coverage is reduced, that's where the reduced is at. But paid up, that means it's gonna be to age 100. The extended term
Okay.
is that the coverage stays the same, but the coverage ends not till age 100, way sooner than age 100.
Okay. Got you.
All right, next one. The interest earned on a policy dividend is taxable. B. Just gonna put that. Throw it in there. The interest earned is always taxable. All right.
Okay.
An insured purchased a 15-year level term insurance policy with a face amount of 100,000. The policy contained an accidental death rider offering double indemnity. The insured was severely injured in an auto accident and died 10 weeks later from the injury. What amount will his beneficiary receive as settlement?
Is it C? This is double.
But that's not the yes, that it is C. But the reason is because there's the guy died within 90 days. 10 weeks is 70 days. So what if so here's the trick question, okay? The tricky part is that what if the client would have died after 90 days? Would he still have received double? The answer is no.
No.
Because
Okay.
you only get double if you die within 90 days.
Okay.
See how they're trying to trick you there?
Yeah, I see it.
So this one, they didn't trick you because you would have gotten it right because of the double. They would have tricked you if it would have been, I don't know, what is 90 days? That's, let's say 20 weeks, Then it wouldn't be C, it would just be B if it was more than 90 days. Get it?
So you really got to just pay attention whenever you're reading them.
Yeah, and you gotta know the concept. That way they could throw it at you. It doesn't matter. You'll get it right if you know your stuff. All right, next one. A father owns a life insurance policy on his 15-year-old daughter. The policy contains the optional payer benefit rider. There it is again, payer benefit rider. If the father becomes disabled, what will happen to the life insurance premiums?
Is it D?
D, yes. Premiums will be waived until she's 21 years old. Excellent. Yes. That's right.
I've seen that one so much it just kind of like stuck. You can't miss it.
Right. Yeah, yeah. Yeah, that's true. Very cool. All right, next one. All of the following are true regarding insurance policy loans except. So you could pull out policy loans if they have cash value. Okay, so think of that.
Mhm. Cash flow. Is it hold on.
Policy would terminate if the loan plus interest exceeds.
Is it C?
No. All the following true except. Oh, good job. Good job. Yes, that's right, Reina. It is C because you have to have cash value in order for this to work. Perfect. Perfect. Great job. So this is good for you to screenshot and read A, B, and D because those are things that have to do with cash value and policy loans. So that's
Cash.
really good. Really, really good. All right, next one. All right, let's see. Give me 1 second. All right, so let's see which option is being utilized when the insured accumulates dividends and interest and then uses the accumulated dividends plus interest and the policy cash value to pay the policy up early.
Is it uh is it paid up additions?
Paid up additions. Oh man, it's either B or D. Let's go with B. Yeah, it's B. So yeah, so you almost got it right. Paid up, it was a key word, but it was a paid up option because it's not talking about adding more coverage. It's about the same coverage paying it up, paying it off, being paid up.
Yeah.
Yeah, so it was a little tricky. This was a little tricky. All right, next one. All right, okay, we passed it. Always review the questions you get wrong so that you could didn't do it, but always review the questions you get wrong. Let's do it again, okay? This
Okay.
whole recording is about this chapter, so let's get this thing done. All right, all of the following statements concerning dividends are true except.
Hmm. Is there? Is it C?
They stem from favorable underwriting experience funds concerning dividends. Dividends amounts are guaranteed in the policy. Dividend amount are guarantees in the policy. So the answer is A. Dividends are never guaranteed. Okay, so make sure that you remember that one. If they ever insinuate or they're trying to make you or trying to convince you that dividends are guaranteed, they're never guaranteed. Never, 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 never. Okay.
I got you.
An insured has a life insurance policy from a participating company and receives quarterly dividends. Has instructed the company to apply the dividends to increase the death benefit. Now it's paid up additions. You see that? Because you're increasing the death benefit. Remember the one
Okay.
those paid up additions? It was wrong because it was keeping the coverage the same. But at this one, in this case, it's asking to get more coverage. So now you know that it's going to be paid up additions.
Got you. Okay.
Yeah. So that's good. That's really, really good. Give me one second. All right, next one. An insured has a life insurance policy from. Oh, wait, did this one? Jay applied for life insurance policy on January 10th, and the policy was issued on January 31st. All right, so the agent was on vacation at the time the policy was issued. All right, on vacation was the time, and so Jay did not receive the policy until February 18th. Then Jay decides he doesn't want the policy. When would he need to return the policy in order to receive the full refund? So remember, it's talking about the free look period. The free look period starts when the policy is delivered. So don't forget that.
Mm.
So what do you think?
Hold on.
It's gonna be.
Got you. Okay.
You see how that works? It's when the policy is delivered. That's the catch right there. That's the key right there.
I was stuck between B and D.
Yep. All right. Make sure you're screenshotting the question. The accelerated benefit provision will provide for an early payment of the death benefits when the insured what?
Is it D?
No, not B. So accelerated benefit is when the person becomes terminally ill. If you said D, I thought you said B, okay? But it is D.
Yeah, I said D.
All right, perfect. You're right. You are right. So yeah, so it's D. It's accelerated benefits. It's a benefit for people that are terminally ill. All of the following are the most common variations of long-term care policy. Yeah, this one's kind of lame that they talk about long-term care, to be honest.
So, maybe D.
Most common variations in long-term care. So yeah, I'm gonna go with D too. Good job. Yep, it's D. Great job. All right, next one. What's up, bro? Next one. What is necessary in order to be eligible to receive benefits from a long-term care policy?
Mm, either is hold on. Either is B or C.
B or C? Let's go with B because I don't know this one, to be honest. Yeah,
Okay.
it's D. Can you screenshot that and just review it later? Because honestly, I don't. Long-term care is I don't even know why they bring it up on the life insurance exam. It's not even a life insurance product, but it is what it is. Screenshot it, and then you could delete it off your brain once you pass this test. How for how long is an insurance company allowed to defer policy loan request?
Hold on one second.
Yeah.
Ooh,
Tasting center because I still have to take my fingerprint.
these are the ones I really have trouble with. I get them all mixed up.
Testing center, it's better
Idiot.
here because testing center is in San Diego, LA. You have to drive out.
Okay, let's schedule it for how it was. I'll do it at the office.
How long is an insurance company allowed to defer policy loan requests? Defer, the answer is 6 months, okay?
6 months.
Yeah, that's the answer.
Okay, I screenshotted it.
Okay, perfect. Okay, all of the following are true regarding guaranteed insurability, right or accept. Guaranteed insurability rider. Remember, this is if you want to, actually, we haven't gone over this one, but this is when you want to go get more coverage because you're not sure right now, but in the future you want to get more coverage, but you want to make sure that your health doesn't affect your ability to get more coverage.
Gotcha. Um, um, is it hold on. Is it C?
Um,
That's tricky.
Riders available to insurers with no additional premium. Yeah, it's gonna be C because it is gonna cost more money. So good job. Good job, good job, good job. Yeah, there you go. You're getting it. I mean, this chapter is getting easier and easier for you now. So the insured has a wife named as a beneficiary of a life insurance policy to ensure that his wife had income for life after the insured's death. He chose the life income settlement option. Okay. The amount of payments will be determined by taking into account the following except.
Mm, um, I think it.
The insurers, beneficiaries. I'm gonna go with oh, I got it wrong. B. B's the answer. The insured's age at death.
I was like, yeah,
That
sure.
makes sense. That makes sense. And the reason it doesn't matter the insured's age is because he's dead. It's the benefit is not for him. The benefit is for the beneficiary. The
Gotcha.
beneficiary. All right, cool. That's good. All the following are dividend options except fixed period settlement options. These are fixed period installments. Dividend options accumulated at interest, reduction of premiums, paid up additions.
Okay, we can eliminate the um,
Paid up additions, reduction of premiums, paid up additions, accumulation at interest, fixed period installments. Dang, I don't know this one actually. To be honest, I think it's gonna be A. Yep, it's A.
okay. I kind of thought A, but I was like, that's a tricky one.
Yeah, this was tricky to be honest. All right, let's go to the next one. An insured pays $1,200 annually for life insurance premiums. The insured applies this year's $300 worth of accumulated dividends to a next year premium, thus reducing it to $900. What option did he choose?
um, is Oh, hold on. Let me reread it. No.
So this one,
Is it?
the answer is A because it's reducing the premium. So the premiums were 1,200 and they got reduced to 900. So they use the dividends to reduce the premium. That's why it's A. Get it?
Yeah, I got you.
All right, cool. Let's go to the next one. The life insurance policy clause that prevents an insurance company from denying payments of a death claim after a specific period of time is known as what?
Hold
Remember this one?
on 1 second. Is I don't, is it C?
The answer is C, incontestability. You're right. It is C. Incontestability clause. So you got it right. Good job. Upon the death of the insured, the primary beneficiary discovers that the insured chooses the interest-only settlement option. Interest only. What does this mean?
They'll only receive like the interest, right?
Yep. So the primary receives interest upon death, and the second beneficiary will receive the share of interest payment. The beneficiary receive payments of interest earned at the death benefit. A beneficiary must pay interest. No, the beneficiary only receive payments of interest earned on the death benefit. The answer is C.
Okay, yeah. Okay.
Got it?
Yeah, got it.
Let's go to the next one. Which life insurance settlement option guarantees payments for the lifetime of the recipient, but also specifies the guaranteed period during which, if the original recipient dies, the payment will continue to a designated beneficiary?
Is it?
The answer is B. Yeah.
Okay, I thought it was, but I had to reread it.
Yeah, because it says period certain. That's the key right there. It says period certain.
Okay.
All right, this is the last one. I actually have to jump on a different meeting, but I'm gonna post this up on the Telegram so you can watch it later on. Okay.
Okay.
If an insured under a variable life policy dies, how will the insurer respond to outstanding loans?
Is it C?
The loan amounts are deducted from the death benefit. Yes. Good job. Yes, yes, yes.
Okay.
I mean, that's what it's all about. Just taking the quiz over and over until you are feeling like, all right, you know what, I got this. And you know what? Here's another tip. Whenever you're having trouble, like, let me stop the recording. Whenever you're having trouble